The earliest form of banking can be traced to a time known as the early dynastic period in Mesopotamia, roughly 3500 BC to 2300 BC. During this era, people began exchanging goods and services, using tokens as currency. The legendary Knights Templar was an influential financial institution in the medieval period. They were a Christian military order founded in 1119 CE and granted many privileges by the Pope, including the right to operate banks. Initially, it was a practical solution for pilgrims who were often robbed on their way to Jerusalem. Before embarking on a journey, pilgrims simply deposit valuables at a Templar outpost and receive a paper they can redeem once they arrive at the destination. The Templars eventually developed sophisticated banking systems that were used to manage their own funds and those of their clients. They also provided loans to knights and other individuals and were active in raising capital for various causes. In ancient Greece and Rome, banking practices developed, with merchants using a credit system to finance their businesses and individuals using early mortgage loans to acquire property. Fun fact: the word bank has its origins in the Italian word banca, which means bench or counter. In medieval Italy, moneylenders and money changers usually conducted their business on public benches. These individuals would exchange currencies, provide loans, and facilitate trade transactions. The Italian banking system significantly developed modern banking practices, particularly in cities like Florence, Venice, and Genoa. The Medici family, an influential Italian banking dynasty, was instrumental in the banking industry's growth during the Renaissance in Europe. Modern banking practices, such as loans and mortgages, emerged in the 19th century with consumer banking and credit. Banker J.P. Morgan, an American, played a crucial role during the Industrial Revolution. Morgan was instrumental in creating the United States Steel Corporation. During the Panic of 1907, he helped stabilize the U.S. financial system by organizing a coalition of banks. This provided liquidity to the economy, preventing a more severe economic crisis. First, banks charge fees for various services, such as overdraft protection and processing payments. Second, banks can lend out a percentage of deposited funds, which earns them interest on the loan. Finally, banks can invest deposited funds in other assets, such as stocks and bonds, which generates a return on investment. Banks can also trade in financial markets to make money. All of these activities help generate revenue for the bank. Using the fractional reserve system, banks are incentivized to loan out more money, as it increases the interest they can earn. Simply put, fractional reserve banking is a system where banks can lend out a certain percentage of the funds customers deposit, rather than keep 100% of deposits on reserve. For example, a bank may retain 10% of deposits in reserve and loan out 90%. This ensures the bank can cover any customer withdrawals while profiting from loan interest. The 2008 financial crisis significantly impacted the public opinion of banks and bankers. Due to its direct link to subprime mortgages and the housing bubble, bankers were seen as the perpetrators of a global economic meltdown, leading to a widespread public distrust of the banking industry. This distrust was compounded by revelations that banks were engaging in risky practices and unscrupulous behavior to increase profits. A loan is a general term for borrowing money from a financial institution, like a bank or credit union, which you agree to pay back with interest over a specified period. There are numerous reasons for making a loan, such as use for personal expenses, payment for education fees, or to start a business. Conversely, a mortgage is a specific loan used to purchase or refinance a property, such as a house or a commercial building. Unfortunately, suppose a borrower fails on his obligation to make the regular mortgage payments. In that case, the lender gains the right to take possession of the collateral property to recover the outstanding debt. The 5 C's of credit is a method lenders use to assess an applicant's creditworthiness. Character refers to the borrower's past credit history. Capacity is the borrower's ability to repay the loan. Capital is the borrower's assets and liabilities. Collateral is the assets used to secure the loan, and conditions are the external economic factors that may affect the loan. Lenders use these criteria to determine if a borrower is a reasonable credit risk and if they should approve the loan. The ideal age for a long-term loan is between 25 and 35. This is because you are at an age where you can make the most money relative to your position and tenure in a company. While it is possible to borrow later, age will be a factor in assessing and determining the lending rate and length of the loan. Banks look fondly to gainfully employed customers, have a stable business cash flow, or receive profits from some previous investment. A smart strategy is to use your money on more profitable ventures by borrowing to acquire a home. You profit long-term from the increase in the property's value while removing rent from your regular expenses. This is the same principle rich people buy houses through mortgages, taking advantage of a loan's leverage. They refrain from purchasing homes in cash since that would be impractical, considering their ability to grow their money. This allows them to reap the benefits of owning a house without using much of their money. In a recent purchase of a multi-million home on loan, billionaire entrepreneur Mr. Mark Zuckerberg of Facebook clearly knows how to use the power of leverage. This is one of the secrets financially smart people use to grow their wealth further. Before jumping in and running to a bank to get a loan, here are some financial advice you may need to consider. First, ensure that your down payment for the property comes from your home savings, not borrowed. Second, consider other incidental expenses related to owning a house. Lastly, ensure that you continue to set aside some money as an emergency fund. We recommend saving at least 20% of your net take-home pay, depending on your circumstances. By taking out a loan, you improve your relationship with a bank. This can mean improving your credit score, becoming eligible for other products like credit cards, granting preferential rates, waiving fees, and access to services like safety deposit boxes that may not be available to regular customers. Today, banking is ubiquitous, with customers able to open accounts, transfer money, and in some cases, quickly take out loans using online banking. Despite the bad reputation of banks, it serves a particular purpose that can best suit all of us as long as we properly learn financial literacy and remain prudent in our money decisions. If you made it to the end of this video and liked our content, we would appreciate it if you could like and subscribe to our channel to help us with the YouTube algorithm. Thank you, and see you again in our next video.